Every empire swears its money is safe. Every government insists its promises will last forever. And every time, history proves them wrong. From Rome to France, from the Confederacy to modern-day Lebanon, people have woken up one morning to find their savings worthless, their wages meaningless, and their futures stolen by the very systems they trusted. Collapse is not rare. Collapse is the rule. The real question is not whether financial systems will fail, but how you protect yourself when they do. The illusion of permanence is the most dangerous financial mistake you can make. We look at our bank balances, our national currencies, and assume they are solid as rock. But money is not rock. Money is trust, and trust can vanish overnight. That is why history is both brutal and incredibly useful. Every collapse leaves behind lessons, patterns, and warnings about what truly preserves wealth and what turns to dust. And if you pay attention, you'll notice something unsettling. Those who survived were not the ones who trusted the most. They were the first to doubt. Welcome to Stories Behind the Money, where power, ambition, and history collide. And every fortune has a hidden cost. Take the Byzantine Empire. It's often remembered as the eastern half of Rome that survived for nearly 1,000 years after the West fell. At the heart of its economy was the gold solidus, a coin so reliable that merchants across Europe, the Middle East, and Asia accepted it without question. For centuries, it was the closest thing the medieval world had to a global reserve currency. Here's the part longtime viewers will appreciate. You would expect the Byzantines to have learned from Rome's earlier disaster with the silver denarius, a currency debased so severely by emperors that it became little more than tin-coated metal. We've told that story before, and yet, centuries later, the Byzantines made the exact same mistake with gold. They reduced its purity, thinned the coins, and mixed in cheaper alloys. At first, no one noticed. Then, trust cracked. The coin that had held Mediterranean trade together suddenly became a political fiction. Debasement destroyed its credibility, and with it, the Byzantine economy lost the stability it once had. So what survived? Not paper promises, not government decrees. Merchants who had accumulated real gold or land beyond imperial reach preserved their wealth, while everyone else watched their money evaporate. This is the first timeless lesson. Governments cannot resist the temptation to debase their currency. And when they do, real value flees into assets they cannot fabricate. But not every collapse comes from rulers tampering with money. Sometimes, disaster arrives from forces no one fully understands. In the mid-14th century, Europe was struck by the most devastating pandemic in its history: the Black Death. Between 1347 and 1351, nearly half of Europe's population died. Cities emptied. Villages vanished. Trade routes collapsed. Yet the economic story of the plague is more complex than pure catastrophe. When half the labor force disappears, labor becomes valuable. Survivors could demand higher wages. Food and land, once scarce, became relatively abundant compared to people. Families with liquidity, silver, goods, or simply the ability to work, suddenly gained bargaining power they had never imagined. Land once worth a fortune could be bought for a fraction of its former price. Homes were abandoned. Fields lay unused. For survivors, the market shifted decisively in favor of buyers. If this feels disturbingly familiar, it should. We saw a modern version during the COVID pandemic. Supply chains broke, governments printed trillions to keep systems afloat, and a wave of inequality followed. Where those with liquidity accumulated assets, while those living paycheck to paycheck fell behind. In the United States, housing prices soared. Stock markets rebounded almost instantly, while millions of ordinary people wondered how they would pay rent. The rhyme is obvious. Pandemics redistribute wealth. They always have. Survivors of the Black Death climbed the social ladder by exploiting scarcity. Those who exited COVID with liquidity bought properties, stocks, and businesses others could no longer hold. The lesson is not comforting, but it is true. Crises reward those with reserves and punish those without. And while pandemics reveal how quickly economies can flip, the banking collapse of Renaissance Florence teaches something just as vital. Institutions that seem too big to fail can fall like dominoes. In the 1340s, Florence was Europe's financial capital, home to powerful banking families like the Bardi and Peruzzi. These houses lent enormous sums to kings, most disastrously to England's King Edward III during his wars with France. When Edward defaulted, the banks collapsed. Depositors were ruined. Trade froze. Florence, once wealthy and powerful, spiraled into chaos. Ordinary citizens who had trusted the city's mighty banking dynasties learned a painful lesson. Size is not safety, and reputation is not protection. What did people learn? That the lie of too big to fail is as old as finance itself. Institutions exist to profit, not to protect you. And when they fall, they take your savings with them. This lesson repeats every century, from Florence's collapse to Lehman Brothers in 2008, to Lebanon's banks freezing accounts in 2019. Survival belongs to those who understand that institutional promises are only valid until the day they aren't. The American Civil War is usually remembered for its battles, politics, and the abolition of slavery. But behind the gunpowder and speeches was a brutal financial war most Americans barely understand today. Both the Union and the Confederacy realized that fighting a war at that scale required printing money. In the North, the government issued paper currency called greenbacks, backed not by gold, but by the promise of the United States itself. At first, the experiment seemed bold and patriotic. But the more greenbacks entered the economy, the more their purchasing power declined. Inflation eroded value, and trust weakened. In the South, it was far worse. The Confederacy printed staggering amounts of graybacks to fund the war. By its end, Confederate inflation reached almost unimaginable levels. Prices rose by thousands of %. Wages became meaningless. Soldiers were paid with money that lost value before they could spend it. Families carried sacks of cash that couldn't buy a loaf of bread. By 1865, Confederate money wasn't weak. It was dead. What mattered during the collapse wasn't paper promises, but tangible assets. Land, food, gold, anything real retained value, while currency became a cruel joke. For ordinary Southerners, it was devastating. Lifetimes of savings turned to dust. But for opportunists with access to tangible goods, the war was a chance to acquire property and wealth at fire sale prices. There is a lesson Americans rarely hear, but should never forget. Your own country has already experienced a currency collapse. And when it happened, protection didn't come from trusting paper in your wallet. It came from holding value the system couldn't inflate. France offers another ruthless example of how revolutions can destroy money faster than wars. In the 1790s, after overthrowing the monarchy and seizing church lands, revolutionaries issued a new paper currency, the assignat. In theory, it was backed by confiscated property and meant to stabilize the economy. Instead, the government printed without restraint. Each new issue diluted the last. Prices exploded, wages lagged, and soon the assignat became worthless. Farmers refused to sell food for paper, demanding goods or silver instead. Bread riots returned to Paris, and the revolution began to devour itself. The winners of this collapse were not those who held patriotic paper. They were those who held food, gold, or property, things the government couldn't print. For ordinary Parisians, the lesson came too late. No matter how noble the promise, money is only worth what others will accept. When trust breaks, savings don't shrink. They vanish. Fast forward 2 centuries, and the lesson reappears in Asia. In 1997, a speculative attack on the Thai baht triggered a regional crisis. Thailand had borrowed heavily in dollars, trusting that its currency peg would hold. When the system collapsed, foreign-denominated debt became unpayable overnight. Investors fled. Across Southeast Asia, Indonesia, Malaysia, South Korea, currencies fell in sequence. Economies contracted. Unemployment surged. Governments begged the International Monetary Fund for aid. The ones who suffered most were not the global hedge funds that sparked the panic, but ordinary citizens whose savings evaporated, mortgages doubled, and jobs disappeared. Once again, the same brutal pattern emerged. Those holding dollars or assets abroad survived far better than those who trusted local currency. Countries dependent on foreign debt were forced into austerity, while Wall Street institutions bought Asian assets at pennies on the dollar. What looked like a local collapse was, in reality, a global transfer of wealth. This lesson echoes from Byzantium to Argentina. Borrowing in someone else's money is a death trap. When the storm hits, it's not the creditor who drowns, it's the debtor. By now, the pattern should be clear. Whether revolutionary France, Civil War America, or modern Asia, the same themes repeat. Paper money fails. Debt chains nations and families. And survivors are never those who trusted the system most, but those who recognized its fragility before it cracked. The most disturbing truth about collapse is that it isn't ancient or distant. It's happening right now. In Lebanon, between 2019 and 2021, banks did something still unimaginable to most people in the developed world. They locked their doors. Citizens woke up to frozen deposits, withdrawal limits, and a collapsed currency. The Lebanese pound lost over 90% of its value. Lifetimes of savings became pocket change. People lined up outside banks, begging for access to their own money, only to be told it was gone. And these weren't just small savers. Middle-class families, retirees, doctors, engineers, anyone who trusted the system was wiped out. The lesson was brutal and clear. Money in a bank is not a vault. It is a loan you've given to an institution that may decide not to repay you in a crisis. The best survivors were those who diversified abroad, held gold or property, or kept wealth outside the banking system altogether. Everyone else was trapped. If this feels distant, it shouldn't. In 2008, Americans watched their homes foreclosed and retirements evaporate while the banks that caused the crisis were bailed out. In 2020, trillions were printed to keep the system alive, a lifeline that inflated asset prices for the wealthy while wages stagnated for everyone else. In 2023, U.S. regional banks collapsed almost overnight as depositors lost confidence, reminding everyone that too big to fail is a story we tell ourselves until the door slams shut. So how do you protect yourself when everything breaks? History shows there is no single answer. In Byzantium, it was gold. After the Black Death, it was liquidity to buy abandoned land. In Florence, it was not trusting too-big-to-fail bankers. In the Confederacy, it was tangible goods, In France, food and property. In Asia, avoiding debt in foreign currency. In Lebanon, exiting the system before the doors closed. The patterns change, but the theme remains. Survival comes not from blind faith in paper or institutions, but from recognizing what holds real value when illusions collapse. And here's the paradox that should wake you up. Collapse is both a tragedy and an opportunity. For the unprepared, it's destruction. For those holding unprintable assets, liquidity, or resilience, it's the moment to acquire wealth at a fraction of its former value. After the Black Death, peasants became landowners because there was too much land and too few people. After 2008, those with cash bought homes while millions were foreclosed. History shows us this. Protection is not just defense. It's positioning yourself to acquire what others are forced to give up under pressure. But wealth isn't only about what you own. It's also about what you can do. Survivors weren't just those with gold or land. They were those who could produce value when others couldn't. The baker who could still provide bread. The craftsman who could repair tools. The farmer who could feed a community. The trader who could move goods across borders. These weren't just survivors. They were the ones who rose during collapse. In every crisis, money loses meaning, but production never does. People still need food, shelter, trade, and repair. And those who can provide them rarely stay poor for long. This is the deeper protection. Not blind faith in institutions, not hope that governments or banks will save you, but real assets, real skills, and the awareness that illusions always break. Every crisis is a transfer, from the trusting crowd to the prepared minority, from paper promises to tangible value, from passive savers to active builders. History has shown this pattern again and again. So the question is not whether everything will fall apart. It always does. The real question is whether you'll be holding promises with the crowd, or holding something real with the few. History does not repeat itself, but if you ignore it, it will still crush you. If this video gave you a different perspective, subscribe, because history doesn't hide the answers. It only reveals them to those who know how to look.